By the time 2027 is over, roughly 45 million Americans are going to discover that what they called a diversified retirement portfolio was structurally a concentrated bet on 7 companies priced like gravity has been repealed on their behalf. The part your brokerage statement will never show you, the same mathematical pattern that collapsed France's entire economy in 1720, erased 37 years of Japanese investor gains, and wiped out the so-called safest stocks in America in 1973. That exact structure is sitting inside your index fund right now at the highest concentration levels ever recorded in US market history. And unlike those past collapses, this one has a specific, measurable pressure point baked into the timeline. Not a market crash you can see coming, but a valuation math problem that has been compounding silently every single quarter and which gets stress tested in a very particular way over the next 18 months. My name is Tom. I run Lazy Investor. I've spent 10 plus years running my own business, surrounded by accountants and fiscal lawyers who taught me, among other things, that the official explanation for how money moves is almost never the complete one. I have multiple hundreds of thousands of dollars invested. This is not theory. I read SEC filings and earnings reports the way other people read sports scores, not because it's thrilling, but because the gap between what those documents actually say and what financial media tells you is often staggering. What I'm walking you through today is what I'd want someone to hand me 5 years ago before I understood what I actually owned. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the real weak points in your specific plan. And I only ask for your email to send the report so I don't store any of your financial data. Link is in the description. Here's the central idea I want you to hold on to for this entire video. Your index fund is a house. The contractor told you it's built with 500 different materials, which sounds remarkably solid. What he didn't mention is that 7 beams are holding 30% of the entire structural weight. Right now, those 7 beams are the strongest in the building. The charts say so. The market caps say so. Every financial talking head on television says so. But a house that depends on 7 beams is not a diversified house. It's a concentrated bet wearing a diversification costume. And everything we're going to cover today is about what happens when that costume comes off and what you can do about it before it does. In a few minutes, I'm going to walk you through exactly what I do with my own money right now, knowing what I know about the current valuation structure. But first, let me show you why the word diversification in 2026 has been quietly and almost completely emptied of its meaning. Let's go back to 1718. France is broke. Louis XIV ran up catastrophic debt through decades of warfare, and by the time John Law arrives, the French government owes more than it can repay through any realistic taxation strategy. John Law's Scottish, mathematically brilliant, and absolutely convinced he understood money in a way no one else did, walks up to the regent of France and says, "Let me start a bank, issue paper currency backed by future revenues from French colonial territories in North America, and I'll fix the debt problem." The French government, desperate, agrees. Law creates the Mississippi Company, which supposedly holds exclusive rights to develop all of French Louisiana, a territory that, on the maps of the period, looked like it contained half the world's wealth. Dense forests, navigable rivers, fertile land, and crucially, the promise of gold that nobody had actually found yet. He starts issuing shares. The narrative is enormous. Share prices go from 500 livres to 18,000 livres in under 2 years. The word millionaire is literally coined in Paris during this period to describe the fortunes being generated on paper. People sell their homes, their farmland, their jewelry to buy in. There are documented accounts of crowds so thick outside Law's offices that people were injured in the press. Here's the mechanism. The Mississippi Company had no revenues, no gold, no developed land, no actual products. The price was being sustained by narrative and by new investor money flowing in to replace money being withdrawn by earlier investors. Law was also printing paper currency and using it to buy government debt, which the government loved because their obligations were disappearing. The system required perpetual inflows to function. Rising prices created the impression of quality. The impression of quality attracted new money. New money pushed prices higher. The loop was self-reinforcing right up until the moment it wasn't. In 1720, investors began asking to convert paper shares back to gold. Law didn't have enough gold, conversion stopped, the price cracked. Within 6 months, the shares were near zero. Law fled France in disguise. He died, broke in Venice 9 years later. The French government, by the way, had by that point successfully transferred vast amounts of its sovereign debt onto private investors now holding worthless paper. The insiders who got out early walked away wealthy. The middle class, the merchants, the small landowners who believed the system would protect them, they absorbed the loss. And the people who designed and ran the system faced almost no consequences whatsoever. They moved on to the next problem. This is not just a history lesson. This is a structural template. And I want you to notice 4 specific steps because they repeat in every major concentration collapse since. First, a small group of assets gets identified as uniquely superior to everything else. Second, institutional money floods in, driving prices higher. Third, the high prices become evidence of quality, which attracts more money in a feedback loop. Fourth, conditions change, and the assets that were most overvalued fall the furthest, taking with them the portfolios most concentrated in them. Let me show you the American version of this story, because it happened in living memory, and most people have completely forgotten it. In the early 1970s, there was a concept called the Nifty 50. These were 50 large-cap American stocks: Polaroid, Xerox, Kodak, Avon, Sears, among others that institutional investors called one-decision stocks. The idea was that these companies were so dominant, so well-managed, and so deeply embedded in American economic life that you didn't need to think about valuation. You bought them once and never sold. Some of these stocks were trading at price-to-earnings ratios of 50, 60, even 80 times earnings, which is objectively extreme. But analysts of the era said that traditional valuation frameworks simply didn't apply to companies of this caliber. The quality justified any price. Then 1973 happened. Oil crisis, double-digit inflation, recession. Suddenly the stock's price for infinite uninterrupted growth weren't growing. Polaroid fell over 90% from peak to trough. Avon fell more than 80%. Xerox fell more than 70%. I want to be precise. These were not speculative penny stocks. These were the most recommended, most widely held, most aggressively endorsed equities in America. And if you had bought at the 1972 peak, you waited more than a decade just to break even on some positions in nominal terms before accounting for the inflation that was running at 8 to 10% during portions of that stretch. In real purchasing power terms, many investors never recovered. A financial advisor I once heard about this is a real type of person, not an unusual one, had his retired clients in 3 separate mutual funds to ensure what he described as complete diversification: a growth fund, a balanced fund, and a bond with equity component. 3 distinct products, 3 different labels. When the client added up the top 10 holdings across all 3 funds, they overlapped by more than 50%. Same mega cap tech companies, 3 different fee structures, 1 concentrated bet. The advisor wasn't lying. He was following the template he'd been given. But the template was designed to collect a fee, not to actually assess what was underneath the labels. As of early 2026, the top 7 companies in the S&P 500: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla account for approximately 32% of the total index weight. Back in the mid-90s, the top 7 made up roughly 14 to 15%. We have more than doubled the concentration in 25 years. And the standard recommendation is still the same S&P 500 index fund that everyone's been buying since the Clinton administration, as though the internal structure of that fund hasn't changed dramatically. The mechanism that creates this invisibility is called market cap weighting, and it's worth understanding because it's the engine of the problem. Market cap weighting means the companies whose prices have already risen the most automatically receive the largest share of every new dollar you contribute. Apple reaches $3 trillion in market cap it gets a bigger slice of your next contribution. Nvidia doubles in price, it gets a bigger slice. You are, mechanically and without any decision on your part, continuously buying more of whatever is most expensive and less of whatever is cheapest. That is the structural inverse of every successful long-term investing principle ever articulated. It works brilliantly during extended bull markets where expensive things keep getting more expensive. And when the cycle reverses, it ensures you are maximally exposed to the assets with the furthest to fall. Here's where it gets really interesting, and stay with me, because this next part is the specific piece that financial advisors routinely skip. They're talking to people who are within 10 to 15 years of needing their money. There is a concept called sequence of returns risk that I genuinely believe is the most underexplained, most consequential risk in personal finance for people in their 40s and 50s. Here's what it means. Two investors can have the exact same average annual return over 20 years and end up in completely different financial positions at retirement, not because of different fees, not because of different contribution amounts, but purely because of the order in which the good years and bad years occurred. Let me make this specific. Investor A puts $500,000 into a portfolio and experiences strong returns for the first 15 years, then takes 25% losses in years 16 and 17, then recovers in years 18 through 20. Investor B puts in the same amount, earns the same average return, but the losses happen in years 2 and 3 instead of near the end. Same average, same total contribution. The math, worked out fully, shows that investor A, who took the hit close to retirement, either runs out of money in the early 70s or has to dramatically reduce spending. Investor B, who absorbed the same losses early when their balance was smaller, ends up with substantially more than they need. The sequence is as important as the average. And this is the fact that most retirement calculators built around long-term average returns are specifically designed to obscure. I want you to meet Ray. Ray is 52 years old, and he's done genuinely everything right by conventional standards. He maxes out his 401k every year, has been doing it since he was 31. He's never panic sold during a downturn. He doesn't chase hot stocks. He has $680,000 saved in a target date fund set for retirement in 2035. He's planning to retire at 62. He has 10 years. Ray has never once opened the fund's prospectus and looked at the top holdings. He assumes index fund means diversified because that's what he was told, and it sounds logical on its face. What Ray doesn't know is that his $680,000 currently contains approximately $217,000 concentrated in 7 technology companies. Not because Ray chose them, not because Ray researched them, but because a mathematical formula moved his money there automatically every single quarter. As those companies got larger, Ray is going to be our running example. Because what happens to Ray in 2027 depends almost entirely on decisions he does or doesn't make in the next 12 months. We'll come back to him. But here's what nobody is telling you about the people who came out ahead after every major market concentration collapse in modern history. They weren't smarter. They weren't better stock pickers. They didn't predict the crash. They had exactly 2 things that everyone else didn't. They knew what they actually owned, and they had liquidity when everyone else was forced to sell. That is the entire edge. That's it. During 2008, the investors who bought stocks at 50 cents on the dollar were not geniuses. They were the people who happened to have cash. The people who sold at 50 cents on the dollar were not idiots. They had no choice. Their income had stopped, their expenses hadn't, and their only liquid asset was their portfolio. Same market crash, opposite outcomes, determined entirely by preparation, not prediction. By the way, hit subscribe if this is making sense to you, because otherwise YouTube's algorithm may never show you my videos again, and I genuinely hate for that to happen right before the part where things get specific. Here's a framework I call the 3 layers of exposure. When I apply this to my own accounts quarterly, it gives me a level of clarity I never had when I was doing the standard buy index fund. Do not look at it, trust the process approach. Layer 1 is immediate liquidity. 12 months of your actual living expenses, sitting in cash or near cash, a high yield savings account, short-term treasury bills, a money market fund. Something generating 4 to 5% in the current rate environment, but accessible within days. This is not your investment portfolio. This is your armor. If the market drops 40% tomorrow, layer 1 is the reason you never have to sell a stock at a price set by panicking institutions, just because your heating bill is due. A lot of people hear 12 months in cash and think that's dead money. And if markets do well for the next 2 years, they're technically right that cash earns 4% while your stocks earn 10 and you've left 6% on the table. But if markets crater in month 8 of a crisis year, that cash is the difference between staying invested and selling at the bottom. People who were forced to sell Microsoft at $20 and Apple at $12 in 2008 and 9 didn't lack courage. They lacked a buffer. Layer 1 is the buffer. Layer 2 is your income floor. This is assets that generate cash regardless of what stock prices are doing. Dividend-paying companies with documented histories of maintaining dividends through recessions, not every dividend stock qualifies, but the ones with 20-plus-year track records tend to have business models generating actual cash rather than future promises. Real estate investment trusts that hold physical properties with physical tenants paying physical rent. Treasury inflation-protected securities, if inflation is your specific concern. The goal of Layer 2 is that your monthly life doesn't require you to sell anything at a market-determined price. You spend the dividends, the interest, the distributions, the principal stays. Layer 3 is your growth engine. This is the money you genuinely won't need for 7 or more years. This is where you take real investment risk. And this is where the concentration conversation becomes urgent. Let's put specific numbers on this because I find that abstract frameworks don't change behavior, but specific math sometimes does. If you have $500,000 and apply this structure, $50,000 goes to layer 1, 12 months of living expenses, earning 4.5%, untouchable. $100,000 goes to layer 2 income generating assets, producing roughly $4,000 to $5,000 a year in passive cash. $350,000 goes to layer 3 genuine long-term growth money. Now within that $350,000 in layer 3, if you're in a standard cap-weighted S&P 500 fund, roughly $112,000 of it is effectively in 7 technology companies. 22% of your entire net worth in 7 stocks you didn't consciously select. Here's the inverse concentration move. Take 50,000 of that 112,000 and deliberately relocate it. 15,000 into an equal weight S&P 500 fund, where all 500 companies get the same allocation regardless of size. 20,000 into an international developed markets fund, covering Europe and Japan, which are currently trading at substantially lower price to earnings multiples than the US, and 15,000 into small and mid-cap value funds, which have historically outperformed large-cap growth over 20-year periods, but have been dramatically left behind for the last decade and are therefore relatively cheap. This is not market timing. It is valuation discipline. You are not predicting what happens next. You are reducing your exposure to the most expensive assets and increasing your exposure to cheaper ones. Every successful long-term institutional investor does exactly this, and almost no retail investor is told to do it. Now, this is where it gets interesting because everything I've described so far is the structural argument, and the structural argument alone should be enough to make you check your holdings tonight. But there's a reason I said 2027 specifically, and it's not a hunch. 3 things are converging over the next 18 months that haven't all been simultaneously true since the early 2000s. 1, valuation is at historically elevated levels. The price to earnings ratio on the S&P 500 is currently in the range of 28 to 30 times earnings as of early 2026. The long-term historical average is approximately 16. The Buffett indicator total US market cap divided by GDP is running around 180%. The previous pre-crash peak before the 2001 collapse was around 160%. These numbers don't predict a crash tomorrow. They define the height of the fall if conditions change. 2, the interest rate environment has structurally shifted and is unlikely to revert. The decade from 2012 to 2022 was powered substantially by near zero interest rates. Cheap borrowing meant that companies with no current earnings could grow valuations by buying back stock with borrowed money. That era is functionally over. Rates at current levels mean that companies priced at 30 times earnings need to actually generate those earnings, not just promise to generate them eventually. 3, the artificial intelligence investment cycle is entering what I call its show me the revenue phase. For 3 years, markets have been paying enormous multiples for companies positioned as AI beneficiaries. By 2027, the question stops being theoretical. Either the AI revenues materialize in real reported earnings, partially justifying current valuations, or they don't, triggering a repricing event. Only one of those outcomes is currently priced in. None of these individually is a crash trigger. Together, they define a pressure window, a period in which the 7-beam house is going to be tested in ways it hasn't been tested in a decade. Let me give you the Japan example, because it's the one that makes the market always recovers argument feel a lot less comfortable. In 1989, Japan's Nikkei index peaked at 38,957 points. Japanese equities were the most expensive in the world. Price to earnings ratios were trading at 60 to 70 times in many cases. Japanese companies were buying Rockefeller Center and Pebble Beach. The financial press was publishing serious analyses of whether Japan would surpass the United States economically within 20 years. Analysts of the era said Japanese corporate governance was uniquely superior and that traditional valuation metrics didn't apply. A Japanese retiree from 1990 is somewhere reading this right now. He's been waiting 35 years for someone to say it out loud. The index fell to 7,054 points by 2003, an 82% decline. It only surpassed its 1989 peak in 2024. 35 years to break even. If you were 55 in 1990 with your savings in a Japanese index fund, thousands of companies, apparently diversified, your retirement capital was cut to a fraction within 3 years and never recovered in your working lifetime. I am not saying the US is Japan. The structural differences are significant and real. But Japan's story proves exactly one thing that the financial industry's standard advice cannot accommodate. The market always recovers, is a true statement about a globally diversified portfolio across a full century. It is not a guaranteed truth about a single country's highly valued, highly concentrated index over any specific 15-year retirement window. And the people most exposed to this gap, the people whose personal timeline might not match the market's recovery timeline, are precisely the people in their late 40s and 50s with significant accumulated savings. The same people most likely to be maximally concentrated in the current structure of a cap-weighted US index fund. Now let me bring Ray back because Ray deserves a conclusion. Ray does something radical last weekend. He opens his brokerage account and reads the actual holdings list for the first time in 21 years. He adds up the top 10 positions across his target date fund. He discovers that roughly 32% of his portfolio is in 10 companies, and the top 7 account for more than 22% of his entire saved balance. $217,000 he didn't consciously place anywhere. He's not panicked, he's informed. This is a different feeling. Ray makes 4 changes over the following month. He moves $40,000 from his standard index fund allocation into an equal weight fund. He moves $30,000 into an international developed markets fund. He builds a cash buffer of $60,000 in a high yield savings account, 1 year of living expenses he didn't previously maintain. And he writes down 2 rules on a notepad he keeps in his desk. If any single position becomes more than 8% of his total portfolio, he trims it. If the S&P 500 price to earnings ratio exceeds 32, he moves 10% of his equity allocation to short-term treasury bills. One Saturday afternoon, no new investment vehicles, no complex instruments, no financial advisor needed. Ray now knows what he owns, he knows what he's betting on. And if 2027 turns out to be the stress test year I think it might be, Ray is the person who stays in the market instead of selling in panic, who buys additional shares at lower prices instead of liquidating at the bottom, and who retires at 62 as planned instead of 65 in a cold sweat. Here's the practical translation of everything I've said into 3 moves you can make before this week ends. The first move, open every fund you own and look at the top 10 holdings. Add up the percentages across all accounts, not within a single fund across everything you own. If more than 25% of your total invested money points to the same 10 companies across different products, you are not diversified. You are concentrated with extra paperwork. This takes 20 minutes. Do it tonight. Vanguard, Fidelity, Schwab, they all publish the holdings. The information is free. The second move, if the concentration number you find is above 25%, take whatever is above that line and deliberately move it somewhere lower in the valuation hierarchy. Equal weight domestic funds, international developed markets, small and mid-cap value, you don't need to liquidate. You don't need to panic. You need to rebalance consciously the way an endowment manager would, instead of letting market cap math rebalance on your behalf toward the most expensive assets available. The third move, determine whether you have layer 1 in place. 12 months of living expenses in cash or near cash. If your answer is no, that is the first structural problem to solve before any investment optimization matters. Because without layer 1, you are one bad year away from being forced to sell at whatever price the market is offering at the moment you most need money. That is how ordinary people absorb the losses that patient capital harvests as opportunity. You think the problem is that you're not getting high enough returns. But the actual problem is that you don't know what your current portfolio is betting on, and you have no armor if the bet goes wrong for 18 months at the wrong point in your timeline. Lazy investing built more fortune than crypto memes. The financial industry will keep describing your 32% concentrated index fund as diversified because it has 500 names on the label, and changing that description is not in anyone's economic interest. John Law would recognize the mechanism immediately. 7 beams holding 30% of the weight, the contractor calling it a sturdy house, and everyone nodding because it's easier than doing the math. Go check your holdings tonight. The house is still standing. For now,